friends. Welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. Once again, we have another great podcast episode lined up for you today. Today, episode number 446. We've entitled this one, Safeguarding Your Future. Now, of course, this episode is going to be one that's going to be diving deeper into the 5 levels of financial freedom, specifically level 2, as we unpack the essentials of how to safeguard and protect your future, quite frankly, right? Your future financial security. We're going to demystify some jargon here. We're going to provide some actionable insights to help you make informed decisions. So without further ado, let's begin this journey to safeguard your future and build a fortress of financial resilience right here on Follow the Money Radio. All right, so welcome to today's podcast episode. As we mentioned, we're moving deeper this week into the level 2 of our 5 levels of financial freedom as we continue to lay that solid foundation for the wealth building process. As you heard, my name is Jerry Robinson here at followthemoney.com. It's great to have you here. At any point during today's episode, if you want to go and check out our 5 levels of financial freedom, they're completely online for free, entirely free. Followthemoney.com/5 levels. And you'll notice that we're going through level 2 today, but we've been going through level 2 now for 2 consecutive episodes. We have one more episode, the upcoming episode next time. We're going to finish up level 2, but level 2 is a very important aspect of our 5 levels of financial freedom. And we're going to begin today by talking about the second segment or the second layer of level 2, where we really talk about income protection. We're talking about safeguarding your future, and we're talking about income protection. So let's talk about it. Let's break it apart, and let's just begin with a simple question. What is your greatest asset? It's a serious question. What is your greatest asset? Well, many people will respond to this question with the following answers. They'll say something like my home, or my automobile, if you have a really expensive automobile, or maybe my business, which in fact is true in many cases for some people. And the list goes on and on and on. And while all of the things there are important, the truth is that for most people, the greatest asset that they have is their ability to earn income. Right? Let's just think about it for a minute. Let's say that you're a 35-year-old and you're currently earning $50,000 per year. Okay? So if you're like most people, you're hoping to retire around the age of 65. So therefore, over the next 30 years, which you'll be working, your earning potential is at least $1.5 million. That would be 30 working years times $50,000 per year. Assuming you didn't get any raises, assuming your income never went up, then you would have at least $1.5 million in earning potential. Now, you may be listening to this and you may say, well, that's not what I make. Well, you can just take a minute and do the exercise on your own. You can figure out how much is my ability to earn income worth by taking the number of years until retirement and then multiplying that by your annual income. And if you expect it to go up, you might make adjustments for that. And that calculation, that figure equals your income producing potential. Now, when you take that number, and for some people, it'll be $1 million. For others, it'll be more. Some might be a little bit less, but it all depends where you are, at the current stage of your life. But now take that number and compare that number to the value of your home or to the value of your automobile. And as I mentioned, obviously, the closer you get to retirement, the lower your total earned income potential becomes, of course. However, your income earning ability is usually your greatest asset for the majority of your working life. And for most people, the difference will be astounding when you consider the value of your home or your car or something else that you have, some other asset, to your income producing ability, right? Your income producing potential. And what's ironic is that most Americans spend more money insuring their automobile or their home than they do their ability to earn income. Right? This is kind of backwards, isn't it? So you look at the vehicle out in your driveway, you say, well, it's worth $30,000. You say, well, I'm insuring it and I'm paying, $100 or $200 a month or whatever it is. And then you realize, well, that asset's only worth $30,000 and I'm paying insurance. Well, of course, it's the law. You have to. And we talked about that in our last episode. Proper auto and home insurance covers you and your assets in the event of a minor accident or even a worst case scenario. But if your home and your automobile are worth protecting at their current values, then how much more so is your income producing ability and your income earning potential worth protecting? Right? The most obvious way that your income earning potential could be disrupted is through what? It's through some sort of short-term or long-term disability. Now, before we continue, let's consider these cold, hard facts about the chances of becoming disabled in the United States. I know this is a somber topic, but it's just the truth. We got to talk about it, These are the things that many people won't talk about when they talk about wealth production, when they talk about producing wealth and, creating wealth. Many times they forget to plug the holes in the dam. And so they may, build a nice castle, but they forget to make the moat. And as we all know, that can be a dangerous thing. So before we continue, let's consider some of these cold, hard facts. We got 3 in 10 workers entering the workforce today will become disabled before they retire. That's according to the Social Security Administration. The U.S. Census Bureau has this information. Over 51 million Americans are classified as disabled, representing 18% of the population. This according to the National Safety Council. In the last 10 minutes, 498 Americans became disabled. Isn't that something? How about this from the Social Security Administration? 70% of the private sector workforce has no long-term disability insurance. And this from the Policy Journal of Health Affairs says disability causes nearly 50% of all mortgage foreclosures, and 2% of them are caused by death. So it may seem that the worst thing that could happen to your financial plan is for the primary breadwinner in the family to die prematurely. And while that would be extremely sad and obviously not a good situation, in reality, a permanent disability of an income earner can actually put more pressure on your family's financial plan. And that's because when someone dies, the family's income and expenses will typically decrease as a result. However, when disability can actually, whenever you have a disability, that can actually cause household expenses to increase despite a loss of the income. So in short, a disabling injury can be devastating to your financial plan. And as I was telling you earlier about some of these facts, these cold, hard facts, the U.S. Census Bureau estimates that nearly 1 in 5 Americans will become disabled for a year or more before the age of 65, for all ages. And when so many families are living from one paycheck to another, even a short time out of work could be devastating. Just ask yourself, could you or your family afford to live without your income? Right? It's kind of a good exercise to ask. What happens if my income went away? When you consider that nearly 1 in 3 people between the ages of 35 and 65 will face a disability and be unable to work for 90 days or longer, and that the average length of a disability is anywhere from 3 to 4 years, it's no wonder that dealing with this topic is vital to your financial future. It's obviously a somber topic. It's not a fun topic, obviously, but these are topics that we have to confront. We have to think about these things ahead of time instead of thinking about them after. Remember, there are no do-overs in level 2. You've got to think it through, and you've got to say, what do I want to cover? What do I want to protect? How big do I want my moat to be? Therefore, the first income protection strategy to consider for you and your family is disability income insurance. Now, as most people know, if they work at a company and that company is somewhat large, if it's not a tiny company, not a small company, then you're normally going to have some sort of disability insurance that's made available to you through the HR department, through your benefit plan. And I just want to talk through this just for a few minutes because it's so powerful for those of you who have access to that at your employer. There are at least 3 different primary insurance-related income streams that can be generated by your family when a disability occurs. These 3 include Social Security. So there's a Social Security disability insurance that you can apply for. Most people are turned down, but that's one stream. Another stream is the employer-provided benefits that you may have, a short-term or long-term disability plan at work that you can pay for, usually very heavily subsidized, and so it costs very little. And that's the second income stream that you could have in the event that you had a disability. And the third one is your own individual disability insurance plan. So let's go through these real briefly. First, there's social insurance. So you have Social Security disability income. It's known as SSDI. Now that pays benefits to you and certain members of your family if you are insured, meaning that you've worked long enough and paid Social Security taxes. Now, many people mistakenly think and believe that they don't need any disability insurance because the Social Security system will take care of everything if they become disabled. And this is a very mistaken belief that can cost you big time. According to the Social Security Administration, only 39% of the 2.1 million workers who applied for benefits way back in 2005 were approved. That number is even lower today. It's around 37 to 38%. Okay. Why? Because the definition of disability under Social Security is different than that of other programs. Social Security pays only for total disability. No benefits are payable for partial disability or for short-term disability. So in essence, to qualify for Social Security disability payments, you must prove that you cannot perform any job. Okay, so Social Security disability, it's very unlikely that you're going to qualify for it. And even if you do qualify for it, it may take quite a long time to actually get those payments being made. And again, the odds of being approved are very, very slim. So keep that in mind. The second type, as we mentioned, of disability insurance or disability income could come from your employer-provided benefits. So many corporations, as I mentioned today, offer short-term disability insurance as a group benefit. In the event of disability, then short-term plans are typically designed to pay a portion of your salary for 13 to 26 weeks after a brief 7-day waiting period. Now, some corporations offer long-term disability insurance as a group benefit as well. And in the event of a major disability, these long-term plans will cover a portion of your salary for anywhere from 2 years to life. It all depends on the plan itself. Now, typically these plans are subject to a 3 to 6 month waiting period. That means you're going to need some cash, and that's where your diversified savings that are building up in our 5 levels of financial freedom is really going to come in handy. And most group long-term disability plans cover 60% of one's salary to a maximum of, say, $10,000 a month or so. Every plan is different, so you'll have to talk to your HR department. But when I offer financial coaching to clients, I almost always recommend that they take advantage of their short-term and long-term group disability plans through their workplace. These plans are usually very reasonably priced. Oftentimes, they're just pennies on the dollar for what you would normally pay. And if you ever need it, you will be so glad that you paid the small price for it. Now, there's a couple of caveats to keep in mind when you're thinking of your employer group benefits for disability. Number one, as with most group benefits, the disability policy that you can purchase through your workplace, they're not portable. This is very rare that you're going to find a portable insurance plan through your company. So that means that if you lose your job or you get laid off or you decide to move on, then you're going to lose those benefits. You can't take them with you. Now, that's different with health insurance. We'll talk about that in a minute. But your disability, it's just, you're going to be out of luck. And because of group benefits, because those costs are taken out of your paycheck on a pre-tax basis, this means that your group disability benefits, if you ever need them, are going to be taxed. So not only would you be only receiving a portion, maybe say 60% of your previous salary if you became disabled, but it would also be taxed. And so for those reasons, many people purchase their own individual disability insurance policy. That way it's portable, and that way it pays out the benefits tax-free. So let's talk about that third option, individual disability income policy. Now, when you talk to your insurance agent, typically, you're not going to hear about disability insurance. Sadly, it's not something that many people talk about. We talk about it here at Follow the Money. We talk about it in our 5 levels of financial freedom. I talk about it to our coaching students. I've had people who have called me or emailed me and said, Jerry, if you had not told me about disability insurance and I had my accident, I would be so unbelievably unprepared. We've sadly seen a few of our members and students and also, just listeners over the years who have heard us talk. We do this annually. We typically go through our 5 levels of financial freedom annually and just kind of do these reminders. This is a great opportunity for you to rethink your moat, rethink that moat around your castle. Are you protected the way that you want to be protected? So let's talk about that individual policy like I was talking about. The final layer of protection that you can place over your income is through the purchase of an individual disability insurance policy. Now, immediately, what comes to mind are small business owners and employees of companies that don't offer any type of disability income protection. These are the first ideal candidates that come to my mind for this type of coverage. According to the Council of Disability Awareness, more than 100 million workers in the United States are without private disability insurance, and 70% of workers in the private sector have no long-term disability insurance through their jobs that would keep them, providing them with a regular paycheck if they became either permanently or temporarily unable to work. So a quick test to determine if you should consider this type of coverage is to ask yourself these questions. Number one, how would I pay my monthly bills if I was unable to work for an extended period of time? Again, it's not a fun thought. It's not something that any of us think is going to happen to us, but we want to ask the question if we're actually going to make a real financial plan. We actually have to ask the tough questions when we create a financial plan, because if we don't ask the questions, we may get blindsided by life. Life is very uncertain. And if we don't make preparations, sometimes we can get caught flat-footed. So how would you pay your monthly bills if you were unable to work for an extended period of time? Also, is your current financial plan able to withstand the loss of your income for 6 months? Could you survive without any income that you currently receive from your work for 2 years, maybe 5 years? Now, if your plan is able to withstand such financial pressure, then congratulations. You are part of a very select few. However, if you're like the 2/3 of the U.S. population who live paycheck to paycheck, then you should immediately consider investigating the benefits of a disability insurance policy. Why? Because if you even remotely want a stream of income pouring into your life in the event of an unforeseen disability, you will only be able to qualify for it before you need it, right? That's the important thing to remember about insurance protection. You cannot buy it when you need it, right? When you need it, it's too late, right? Remember, there are no do-overs. That's why level 2 of our 5 levels of financial freedom is all about protecting you, your family, and your assets from unforeseen circumstances and events. A recent survey by the Life Foundation showed that 84% of Americans strongly agree they should insure their cars. 80% feel it's critical to have homeowners insurance. That number's dwindling, by the way. Yet only 48% believe it's imperative to have disability insurance if they have a job. And this probably explains one recent study that demonstrates that unexpected illnesses and injuries cause 350,000 personal bankruptcies every year. Don't allow your plan to fail because of an oversight or wrong thinking. Don't become a statistic. So how much does disability insurance coverage, how much should you buy? Only you can ultimately determine the answer to that question by examining your own personal financial situation. However, allow me to stir your thinking on this matter for a moment. To illustrate, let's imagine that tomorrow you were to become disabled after a bad auto accident. I know it's morbid, but just go with me here. Let's just work through this thought experiment. The injuries will force you to be bedridden with little chance of returning to work for, let's just say, for up to 3 years. You have no disability insurance and now desperately wish that you did. Now, if you could somehow turn back time and purchase a disability insurance policy before the accident, how much would you buy? Would you buy just enough just to get you by, or would you buy the maximum? Now, in my own experience, the answer to that question really depends upon you, but most people would say, I want maximum benefits in that scenario, right? So why would you buy less? If it's a matter of cost, then you want to speak to a trusted insurance agent or a financial advisor in your area. The good ones can show you how to maximize your benefits while minimizing your costs. And it's not a one-size-fits-all affair, though. A good disability insurance agent will assess your income, your monthly expenses, and other financial obligations, and to make sure that you're adequately protected and maintaining your financial stability, even if the unexpected strikes through that policy. But like any protection component of your plan, there's going to be limits. There's exclusions, there's waiting periods, all in the fine print that you need to be aware of. And they dictate when and under what circumstances your coverage will kick in. Understanding these details is vital to avoiding downside surprises further down the road. The rule of thumb that I've often said is to have approximately 60% of your income covered by disability insurance at the bare minimum. And you'll rarely be able to buy more. But if you can, I would. The cost of a disability insurance policy will vary based upon your income, your age, and your occupation. And the most comprehensive disability insurance is known as own occupation coverage, OWN. That's the type of policy that entitles the owner to benefits if the injury or illness prevents that person from continuing his or her own current occupation. So, for example, if you're a surgeon and then you lose, the ability to use your hands, or you lose an arm or something in an accident, Well, then he or she could not perform surgery anymore, but they could still teach at a medical school. Well, own occupation disability insurance would cover that in that case, because you can't do your own occupation. You may be able to do something else, but you can't do your own occupation. Therefore, it'll kick in and pay. The other two main types of disability insurance are any occupation and modified any occupation coverage. I don't want to get too deep in the woods here, but policies that use an any occupation definition don't provide benefits unless you are unable to perform the duties pertaining to any gainful occupation. So under this definition, a former tennis instructor confined to a wheelchair would get no benefits because he or she could work as a telemarketer, right? Or work from home or do something else. And then modified occupation plans are a bit more generous. These plans consider a person to be disabled if he or she cannot work in any capacity for which he or she is reasonably suited on the basis of education, training, experience, and sometimes economic status. So own occupation means that you receive benefits if you're unable to work at your specific occupation, even if you're able to do other work in other occupations. So, that's a really important thing to know when you're shopping around for disability insurance. And I can't stress that enough to you that, again, most people can get covered at work. Don't plan on Social Security covering you for disability. As we've said, it's very hard to get approved. Most people get declined. Veterans can't hardly get it at all. And when it comes to disability insurance, if you have it at work, well, then sign up for it. I would run, not walk, to my HR department and make sure that box is ticked, and that I'm paying the pennies on the dollar to be covered by short-term and long-term disability at work. But if you have the means and you have the desire to look into your own policy, then that can be even better. That way it's portable, you can take it with you, and you also receive the benefits tax-free. Again, I've seen many people benefit from having this in their plan, and it prevents them from having to drain down their assets during a time of disability. And again, disability could be a broken leg. It could be, it could just be stuff that happens in life. It doesn't have to be some sort of morbid disease that puts you in bed forever. It just could be something that just takes you out for a year or two. Things can happen. And if you're not prepared, well, you're going to have to eat up your assets to cover your life's expenses and maybe even more expenses than normal being disabled. So that's a really important topic to cover in your own mind and your own family. You want to be thinking about, how am I going to handle this topic of disability? Am I going to self-insure? Am I going to just go ahead and just roll the dice and self-insure? You can certainly do that. But if you need it, remember, you can't run and get it. We've said it over and over again. Most insurance, not all, in some cases like health insurance, you can have pre-existing conditions. But when it comes to life insurance or disability insurance or, some of the other types of insurance, auto insurance, you can't go get in a wreck and then go buy auto insurance, right? You can't go break a leg and then go buy disability insurance. You have to have it before you need it, right? And that's kind of the irritating thing about insurance is that, you got to have it, you got to buy it before you need it. But when you need it, you can't buy it. So keep that in mind. All right, so we've covered disability insurance. I want to talk about two other forms of insurance that can protect your income. We're going to talk a little more briefly about them because they're pretty in depth, and we're not going to spend a lot of time talking about them because we could spend a whole episode on each one of them. In fact, all of these. And we're going to talk about health insurance and also long-term care insurance. We're going to do that on the other side of this break. Hold tight. Friends, we're eating our vegetables today. We're really digging down deep into some tough topics. We're talking about things that many people don't want to talk about, and many times, even a financial advisor won't talk with you about. Not because they don't care, not because they're just not thinking about it. Maybe they don't sell disability insurance, or maybe they don't know anybody who does, and so they forget about it. It's understandable that people don't want to talk about these things. It's morbid. Let's be honest. But the fact is that if you want to build a financial plan, it's not just about trading and investing and all of this and buying real estate. You've got to fill the holes. You got to fill the gaps. You got to put your finger in the dike. You got to make sure that all your bases are covered. And that's what we're talking about today. We're talking about safeguarding your future by thinking ahead and being ready for, whatever may be coming ahead. We've got to be ready for it. So let's move on. We talked about disability insurance. We spent a good while talking about that. I find it very important. It's a topic that many people don't think about. The other two things I want to talk about on today's episode before we close out is health insurance and long-term care insurance. There's a lot of questions around these things, but health insurance is obviously extremely complex. With the passage of the Affordable Care Act, also known as Obamacare, they've certainly made health insurance a lot more cost effective, at least for some, not everybody. Many people still complaining greatly about health insurance costs. They are very expensive. But there's all kinds of ways to try to bring those prices down. You can raise your deductible on your health insurance. You can also consider like a meta-sharing plan, some sort of health sharing plan like MediShare or Christian Healthcare Ministries. We've used them in the past. In fact, we still do for our own needs. But today, 1 out of every 3 Americans either has no health insurance or is woefully underinsured. And that doesn't help that health care costs are high and getting higher, right? Many Americans today are hoping to get ahead financially through starting their own business or working hard but climbing the corporate ladder. And yet without health insurance, they're literally just one bad health diagnosis away or accident away from massive medical bills, right? And potentially financial disaster. Now, unpaid medical bills are one of the leading causes of bankruptcy in the United States. And to make matters worse, every 30 seconds in the United States, someone files for bankruptcy in the aftermath of a serious health problem. And because medical and disability issues are so common in America today, we got to confront these things head on. Any financial plan that attempts to ignore these potential wealth destroyers is playing with fire. And usually the best way to get health insurance is through your workplace. Once again, just like disability insurance, if they offer group coverage, and thanks to the Consolidated Omnibus Budget Reconciliation Act, known as COBRA, your group health insurance is portable. Unlike that disability insurance, your group health insurance is portable in the event that you lose your job. They know how important health insurance is. So there's 2 major types of health insurance today. There's HMOs, health maintenance organizations, and then preferred provider organizations known as PPOs. The trade-off between these types of coverage involves costs, basically. When you're looking at an HMO, you're looking at lower cost health coverage, but with limited choices of medical providers, right? And I'm speaking in broad terms. I mean, remember, health insurance is extremely complex. And what I'm going to say today is going to be very brief, and I'm certainly not going to cover every angle of these insurance types. But if you want to use a health provider outside the network of providers within an HMO, you're usually not going to be reimbursed. So you got to kind of know that. PPOs were created as a solution to the limitations inherent within HMOs. So therefore, the PPO offers more flexibility in choosing a provider. However, the trade-off is that PPOs typically cost more. Right? They're usually a little bit more on the monthly layout or the outlay. But health insurance isn't just about fixing what's broken. It's about prevention too. So while health insurance is extremely important, and I would, not want to walk around without health insurance unless I had something else to cover me, like some sort of, major medical plan or, some sort of health sharing plan like I talked about before. We really found for our family that a health sharing plan made a lot of sense for us at our current age and our current health level. But let me say this, it's really not just about fixing what's broken when it comes to health insurance. It's about prevention. That's where the power of preventative care comes in. Regular wellness checkups, screenings, healthy lifestyle choices. These can save you a world of trouble down the line. It's like giving your car a tune-up before a long road trip. It ensures everything's running smoothly. So staying healthy, getting plenty of exercise that will help you avoid some of the most avoidable health complications as you age is so vital. So that's one of the tips we've talked about for many years is the importance of staying healthy. So when it comes to health insurance, yeah, you need it. You definitely need something, right? Some sort of coverage. Most people can get it from work if they have some sort of group plan. That's usually the best way, usually the cheapest way to get coverage for your family or for yourself. But if you don't have access to that and you're just kind of rolling the dice on health insurance, I would encourage you to at least look into a health sharing plan, like some sort of MediShare plan or Christian Healthcare Ministries. I would strongly encourage you to look at that. Do your research on that, because if you currently don't have any insurance, that can really make a big difference for you and prevent you from having major bills that could really crimp and maybe even destroy your financial future. So health insurance, obviously extremely important. and you want to talk to a trusted health insurance agent, to get all the information that you can if you're buying off of the ACA market, or you're buying just personal insurance, be sure to talk with a trusted insurance agent on that topic. Now, as we come to the conclusion of today's episode, I want to close out with long-term care insurance. Right, we've arrived at that critical juncture in our journey towards financial freedom. That long-term care insurance. This is a component of your plan that's designed to provide a safety net against the potentially staggering costs of extended healthcare services. So this is one of the worst, and obviously talking about morbid. I mean, I'm sorry for the topic, huh? But somebody's got to talk about it. We've got to talk about this stuff. And the truth is that, when we think about the costs of nursing homes and the cost of assisted living facilities, many people will work so hard their entire lives storing up, assets, working hard, building a business, buying homes, buying assets, buying stocks, diversifying their portfolio, all of this. And then when they get to the end of the road, they end up giving all that money to nursing homes, right? And they become reliant upon friends, family, and the federal government, right? This is not what people plan. Nobody plans that. It happens. It happens because there wasn't a plan, right? And long-term care insurance is vital. So let's just dive into it. Many Americans work a full lifetime accumulating retirement funds, as I mentioned, buying appreciating assets, creating income streams, only to have their financial plan decimated by an illness during retirement. Some of the saddest financial planning stories that I know of and that I have seen firsthand involve the financial destruction of an elderly couple's finances after a life-changing medical diagnosis requires one of them to move into a nursing home. Now, today, the average nursing home stay costs on average, and this is actually on the low side, $75,000 per year. And if you want a private room, you don't want to share a room, it's going to cost you even more. Okay, so I'm a strong advocate of using long-term care insurance to strategically safeguard an individual's estate. Now, it's true that you can spend down your assets and you can have Medicaid pay for a nursing home in the event that you need it. And I know that some of you are probably listening to this and you may be 25 or 30, you may be young and saying, nursing home? What does this have anything to do with me? Please hear me. Please hear me. The Adonis complex is very common amongst the young, right? But the truth is that you need to hear this, man. You need to hear what I'm saying, because the truth is that we're all, the death rate is still 100%. So everyone is guaranteed to die. That's for darn sure. But what's also sure is that as you age, health complications can grow. And if you're not committed to a healthy lifestyle, then you can run into some issues. And even if you are, life can happen, right? So the importance is that you want to have a plan for this. Some people will say, well, Medicare will take care of that. I don't need to worry about it. No, Medicare is not going to pay a dime for your nursing home. Medicare only handles the hospital. It handles the medical bills. It handles things. But as soon as you need assisted living, as soon as you need to be moving into a nursing home because you can't stay at home or you can't complete the daily activities that you need, can't brush your teeth, can't comb your hair, can't take a shower, can't take a bath, either you got to stay home and somebody's going to take care of you there, or you need to move into an assisted living facility, right? At some point, that can happen to people. And so long-term care encompasses a wide array of services, and understanding the different settings can make all the difference. You got nursing facilities, you've got assisted living, you got in-home care. All of these are options, and each have their own merits. And selecting the right one for your circumstances is really it's really an individual thing. In-home care offers the advantage of familiar surroundings. I mean, quite frankly, if it were me, I'd want to be able to stay home. If I had some sort of thing that happens when I'm older, I don't want to go to some nursing home unless I have to. I'd rather stay home with my family, and have familiar surroundings and preserve a sense of independence. But on the other hand, facility-based care can provide specialized medical attention around the clock. So it's important to weigh these factors and find the right balance for your needs. The goal is ultimately to ensure that you have a plan in place that safeguards both your financial stability and your quality of life, something that protects your heirs as well, from the erosion of wealth that can occur due to a nursing home, right? So by understanding your unique circumstances, you can make informed decisions about the type and extent of coverage that you require. Now, like any insurance, long-term care policies come with specific terms and conditions. It's crucial to delve into the fine print, understand what's covered, what's not. That can prevent surprises down the road. You also want to familiarize yourself with waiting periods and eligibility criteria. These can impact the coverage when it takes effect. For an individual with substantial retirement income and assets, self-insurance can be a realistic option. You could just self-insure. But if you can't self-insure, if you say, well, I don't know if I want to do that, you could rely upon the government, friends, and family to help you pay the cost. But all of those have major drawbacks too, right? So for those who can't afford to self-insure and who don't want to rely upon friends, family, and federal government, for your long-term care needs, the option is to buy a long-term care insurance policy. Now, in closing here, I want to close this out because we are getting near the end here. But, I believe that purchasing a long-term care insurance policy is a great answer for many people. A properly structured long-term care insurance policy can help you protect all of the assets that you've worked hard to accumulate your entire life, allowing you to enjoy them in your golden years. And from my experience, most people would rather that their assets went to their heirs than to the nursing home, right? But long-term care insurance isn't just about securing your assets. It's about preserving your quality of life during potentially challenging times. And with the right plan in place, you can face the future with confidence. Friends, welcome back to the final moments of today's broadcast. I sure hope this has been helpful for you. I know this is, like I said, like eating your vegetables. I know this is a tough podcast episode. And we're going to go into even deeper on our next episode before we get to go to the fun stuff. Many people say, hey, we're going to talk about the investing part and the trading part and the real estate part. They want the sexy stuff. Well, we gotta work through our some of these things that we're talking about now before we get to that fun stuff, huh? And so that's really what we're focused upon here. This and the next podcast episode, where we're going to cover wills and trusts and life insurance and some of those topics that are tough. But we're going to work through them together. We're going to talk through them so that you can have a plan. You can at least think through these things. And if you don't want disability insurance, that's fine, right? If you don't want health insurance, if you want to self-insure, if you don't want long-term care insurance, you say, no, I don't want any of it. That is your decision, right? That is absolutely, positively your decision. No one should make that decision for you. And no one should force you to buy those things, right? You should know what you want to do. But if you don't sit down and weigh the pros and cons of these on your own, and then one day you end up needing them and you can't go get them, well, that's not a good strategy, right? So, you don't want to be in that situation where you're like, oh, I wish I knew I could have bought disability, or I wish I knew I could have bought long-term care, or I wish I knew that this was so affordable, or I wish I would have had better health insurance coverage, or whatever, fill in the blank. You don't want to be in that situation, right? There's no do-overs here. You don't get to redo it. So you've got to have it look just the way you want it to look. Your plan has to be just the way you want it. Otherwise you're going to be surprised. And that's what I don't want for you. For those who are listening, I know each and every one of you don't want to give away your money to nursing homes. You don't want to give away your money to creditors and hospitals, and you don't want to do that. You don't want to be sitting on the couch unable to work for 2 or 3 years due to some sort of, disability that's short term, and that you don't have a plan to be able to pay the bills in the meantime. That could be great pressure. All of these things are part of a good financial plan. And as we wrap up this empowering episode, I want you to remember that your financial security, your financial freedom, it's like a puzzle. And disability insurance, health insurance, and long-term care insurance are just a few of the things that form a significant piece of this puzzle. By understanding the essentials of these types of insurances, you're not just protecting your wealth, you're fortifying your future. These insurance pillars serve as your safety net. They ensure that the unexpected twists in life don't derail your hard work and your long-term financial goals. So embrace this knowledge, ask questions, design a strategy that aligns with your aspirations. Your future self will definitely thank you. I can promise you that. And by the way, if you have questions about these things, and you're not sure who to ask, give us or just reach out to us. Go to followthemoney.com/contact, or you can call us at 800-609-5530. Simply say, I heard Jerry talking about these different types of insurances and I have questions. You may or may not know, but I am a licensed insurance agent. My specialty is life insurance. I help people with estate planning. I help people with charitable giving goals using insurance. It can be a very powerful tool, but I also am licensed to sell disability insurance and long-term care insurance, all of those things. Now, I rely upon other specialists for those, but I can at least point you in the right direction of someone who can help you. So if you have questions about this and you don't know who to turn to, you don't have a trusted, insurance agent that you can turn to who knows this stuff, let me put you in touch with somebody. Just reach out to us, followthemoney.com/contact, and don't delay. Just make this happen. Just shoot us an email. Say, hey, I want you to put me in touch with somebody who can help me with this. I have questions. I just want to ask questions about this to find out if it's right for me. Just let us know. Don't delay. Don't let life, surprise you. Be prepared for what's ahead. Just give us a contact, by phone, 800-609-5530, or just reach out to us by email. Go to followthemoney.com/contact. Fill out the form right there. It'll come right to us, and we'll get right back to you. I sure hope this episode's been helpful for you, and I sure hope that you found something of great value in it. Until our next rendezvous in the world of financial wisdom, keep your vision clear and your future secure. And as always, I'd like to leave you with a final word, this time spoken by former President John F. Kennedy in his 1962 State of the Union address, when he said, "The best time to repair the roof is when the sun is shining." Quite appropriate for today's episode, and that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decision.